Welcome back. Josh Morin here with Infant Financial. If you've made it to this video, that means you've already laid the foundation. In part one, we broke down what participating whole life is, how it works, and why mutual carriers with a century of dividend history are the only kind that we use. So let's take things a step further here. I'm getting excited about this, man. In this video, we're going beyond the theory. We're talking about structure, design, efficiency, compliance, carrier selection, who we work with, because here at Infant Financial, we're not in the business of just selling life insurance. I'm terrible at selling life insurance. We're in the business of engineering financial machines that deliver liquidity, control, and compounding for life. So let's get into it. How do we design a whole life policy that actually works for infinite banking? Let's begin with the end in mind. When we structure a policy for infinite banking, our number one objective is to not maximize death benefit. Well, that's naturally going to happen as a byproduct of a well-built policy. What we're optimizing is for cash value efficiency. Specifically speaking here, we're wanting early cash value liquidity, high early liquidity, so clients can use their money fast, right? You don't want them to wait 5, 10, 15 years. Obviously, if that's their goals and objectives and not to pull the money till later, there are some use cases where that makes sense. But when you're designing a policy to be around high early cash value, your clients are going to be able to use their money early and fast. We also want to create a fast break-even point so they can see positive cash flow much sooner. Now, this is not about creating major gains and interest gains. It really is about cash on cash usage inside of the policy, as well as leverage and creating positive arbitrage outside of the plan for reinvestment purposes, etc. But for now, this is just another talking point, is a fast break even so they can see positive cash flow sooner. We also want to design the policy around strong long-term internal rate of return to outperform their other conservative assets like bonds, CDs, things of that nature on the fixed side of their portfolio. We're looking to create uninterrupted compounding even while the money is being used. And I'm going to show you the reason that we use specific carriers and why it's important to partner with the carriers that we do here at Infant Financial. We're also creating a tax-advantaged growth opportunity to avoid erosion by taxation, because taxes in the future, I would assume, are going to continue to raise. So we want to mitigate ourselves to that tax exposure later on down the road. We are building systems that give clients the ability to capitalize and deploy while still growing their asset in the background. We're doing all of this tax deferred, liquid, and privately controlled. To make that work, we really do need the right combination of premium and paid up additions. And that's what we're going to dive into next. Understanding base premium and paid up additions. Now, every infinite banking policy has two core funding components. And this is really the meat and potatoes of infinite banking. So this portion of this, I'm going to take as slow and methodical as I can, and as well as deliver in a very simple, easy to understand manner. So portion of it's going to be base premium, all right? So this is the required contractual premium for the whole life policy. This is what builds guaranteed cash value slowly. It supports long-term dividend growth and establishes the insurance framework of the contract. So on one side of the spectrum, you have base. On the other side, which is the key component, is paid up additions, which I'll refer to as PUAs. Now, these are elective contributions used to purchase fully paid up mini policies that immediately increase both the death benefit and the cash value. Now, PUAs are the turbocharger of the design. They allow us to accelerate cash value growth early, enhance long-term returns, and provide access to capital without waiting 10, 15, 20 years in traditional whole life insurance or IUL. But here's the key. We must maintain a minimum amount of base premium to satisfy the IRS guidelines and preserve the policy's tax advantages. If we overload PUAs and neglect the base, that's where we run into situations of risking crossing the MEC guideline, which is the modified endowment contract line, which we'll cover next. So let's look at 3 common policy designs. Before I delve into this, just know that some companies have a slight variance. For instance, here's a little trick for all of you. And if you're not part of Infant Financial and you're watching this, at Lafayette Life Insurance, the most efficient design is actually not a 2080, it's a 1783. But for the purpose of this video, we're going to keep all of these numbers essentially that you can apply them that any infinite banking mutual company that we refer to. Example number 1 is going to be a 2080 split, 20% to the base, 80% to the PUAs. So think of it as for every $100, you have $20 going towards the cost of insurance. 80% of that's going towards the cash value. Now, this is a highly aggressive approach for infinite banking, as well as it's ideal for clients who want their cash early. So this is going to be in entrepreneurs, real estate investors, opportunity seekers. About 8 out of 10 individuals are fit this criteria. This is who we typically work with at Infant Financial: entrepreneurs, real estate investors, opportunity seekers looking to create leverage in two different places. These types of plans, when designed properly, break even often by year 4, which is really, really early when it comes to life insurance. Now, the trade off here, which is ultimately not a huge trade off because it's not the main objective of the client, is you're going to have lower long term death benefit, but you're going to have a lot of liquidity in the early years. So, in the long term, your death benefit's not going to be as high, but in the early years, you're going to have much more liquidity. The next example is a 30% base, 70% PUA ratio. Now, my personal policy is actually a 30/70. And the reason being is it's a balanced design. Now, it still offers strong early cash value, but it also, at the same time, provides long-term performance. So this is great for clients who value liquidity but still want a long-term IR, internal rate of return. Well, that's me. That's what I want. I have children, I'm married, and I want to ensure in the long run as well that my dividend performance history is going to be high. So one of the most commonly used infinite banking designs is a 30/70, or what we'll talk about next, which is a 40/60. So example number 3 is a 40/60 blend. This had been notoriously the ratio of all infinite banking practitioners: 40% to the base, 60% paid up additions. Now you're probably asking, well, why would I not want a 10/90? And the reason being is it's, yes, you're going to get a little bit more liquid access on the front end, but on the backside, in terms of long-term growth, longevity, stability, you're going to have much more performance when you're contributing a little bit more to the base. Now, this is a bit more conservative. It has slower early access, but much stronger long-term guarantees. Now, this is going to work for retirees, people who are wanting to create long-term income options where they can offset their tax deferred accounts that are even in traditional accounts, people who are legacy focused clients, or those who are looking for a sit it and forget it structure. This would also be a situation where we paired with limited pay designs for compressed premium timelines. Now, there's no true one size fits all. The client's goals, funding strategy, and timeline should always dictate the design. Our job is to engineer a policy that aligns with how the client will actually use the system. The MEC limit and the 7-pay test. Let's talk about compliance and tax treatment. The IRS places a limit on how much premium can be paid into a life insurance policy before it loses its favorable tax classification. This is called the modified endowment contract, or the MEC limit. Now, if you don't abide by MEC limits, this thing gets a little bit nasty and ultimately completely eliminates why you set up an infinite banking policy to begin with. Now, if the policy exceeds this limit, policy loans become taxable. Withdrawals before age 59 and a half may incur penalties. The cash value becomes treated more like an annuity than life insurance. And ultimately, that's a deal breaker for infinite banking because it eliminates the very features we're designing for, which is tax-free access, control, and flexibility. So what we do is we design these policies to be right up to that MEC limit, but not over it. Now, every policy is stress tested using the 7-pay test, or you'll see TAMRA 7-pay guidelines, which calculates the maximum premium that can be paid in over a 7-year period without violating IRS section code 7702. So put that one on your list. Do a little bit of personal research on IRS section code 7702. So when we say that a policy is fully funded or max funded, what we really mean is it's funded to the top of the MEC line, maximizing what we can contribute without losing its tax benefits. So precision 1000% matters here. And we are not shooting from the hip. We are snipers, man. We are snipers at Infant Financial. Now let's shift from structure to performance mechanics. One of the most important and often overlooked features of a participating life insurance policy is whether the company participates in non-direct recognition or direct recognition. So you're going to hear these two terms, direct or non-direct recognition. Here's the difference so you can understand. Direct recognition. When a policy loan is taken, the company reduces the dividend on the loan portion of the cash value. So this ultimately punishes the client for using their own capital. So think of it this way. If you have $100,000 of cash value inside of a plan and you utilize 40,000 of it, now your annual dividend is going to be based off of the difference of the two. So you're only going to receive your dividend based off of the 60,000, not the full 100,000. This is unlike non-direct recognition, where the company pays full dividends even on borrowed funds. So this is where things get fun, and this is where the infinite banking concept really comes to fruition. So the client earns as if the money never left the policy. Let me say that again. The client earns as if the money never left the policy. If you had $100,000 of cash value, you loaned out 40,000, you still earn compounded interest, dividends on the 100,000, not the difference of the two. Now, with infinite banking, we encourage clients to use their policies. That's the whole point of having infinite banking policy, is to use it and to leverage it, to be a private reserve, private banking for your personal private banking plan in your portfolio. So we want them taking strategic loans to fund opportunities, consolidate debt, or invest in their businesses, which ultimately creates positive arbitrage, which means we want their cash value to continue growing as if it never got touched, even while it's being used in two different places. And that's really the reason that we primarily partner with non-direct recognition mutual companies. As mentioned in the first video, I'll go over a couple that we rely on here. Lafayette Life Insurance, they are phenomenal. I love working with them. They are a member of Western Southern Financial, which is a major financial mogul. So they offer fast liquidity, flexible premium structures, and I have my personal policy through them. Ameritas is where I bring all of my high net worth clientele. Excellent flexibility, and they have really strong dividend performance. And for those that are putting in multiple seven figures per year, there's no PUAs. So there's no limits on how much overfunding or cash value that you can put into the plans. Others may be suitable case by case, but for infinite banking, those are our two primary carriers. They are non-direct recognition companies. Now, choosing the right carrier is just as critical as designing the premium structure itself. Our illustration process. So how do we present this to a client? At Infinite Financial, we don't overwhelm clients with 5 competing strategies or way too many options. We curate 1 or 2 designs that are focused around their goals. And that's why it's crucial when you're having a meeting with your client to really break down their goals, objectives, and what they want to accomplish. Going through financial suitability, what their short, medium, and long-term goals are, what they're focused on. Now, if liquidity is a priority, we'll show them a 20/80 or 30/70 design. If long-term performance is the focus, maybe a 30/70 or a 40/60. What we do is we walk them through meticulously year by year cash value projections. So then they have no guesswork when it comes to how much loan availability that they have and liquidity they have inside of their policy. We'll also show them an IRR, which is internal rate of return. So you can see the differences between the designs. An IRR in the long term on a 40/70 is definitely going to look different than a 20/80. We will show them the minimum and maximum funding options so they have an idea of where they need to be at least on the marker every single year in contributions to the base, as well as what it would look like if they max funded the policy underneath that MEC guideline. The goal here is ultimately clarity, not complexity. Now, I understand these policies are highly structured, tailored, and there's a lot of moving parts, but we're not here to impress our clients with charts. We're here to instill the confidence in the strategy itself. And this is how we help clients make informed decisions, not emotional ones. At this point, you understand the product, you understand the structure, and you understand how to align design with the client's actual intent. In the next video, we bring it all to life. We'll show you how clients use these policies in real world. We'll show you how policy loans are processed and repaid, how to guide clients through objections and liquidity timing, and how to make this strategy scale into multi-generational wealth planning. Now we're moving from design to deployment. It's time to execute now. So we have design and creation to execution. So take time to review this video, study the ratios, understand the tax rules, do some digging and some researching on your own. I highly suggest becoming your own banker by the late, great Nelson Nash. He's the one who really pioneered the infinite banking concepts on practical usage. Obviously, it's been around for hundreds of years. I want you to know the carriers. I want you to know the ins and outs of this plan, design, and execution, because in part 3, we take this strategy off of paper and into practice. We'll see you there.